As of the time recording this video, I should say good afternoon, good evening. But let's keep to the main business. Um, this is a beginner's guide. It's not everything here that I'm going to cover because when you start trading forex, I should say some of them will be foolish, some of them will be useless, or in fact, most of them will be useless, right? But you still have to understand it to go about your trading, right? So let's let's skip to that part. And before this, there are some apps that you have to download. Trading View. Most of you were present in the other group. So you have to get your Trading View, your MT5, because that's what you're going to use. And then you will need two brokers account. I will explain why you need two brokers account. But you need two brokers account and you need XM, right? And then Headway. You find all of them on Play Store or App Store, whichever phone you're using. Now, let's get into business. Um, so when you talk about forex trading, is basically the exchange or basically foreign exchange. That's the um, forex is the short term of foreign exchange or currency trading. It happens when currencies are being traded against each other, right? The main idea is currencies being traded against each other, but we also have commodities being traded against currencies. And there are some cases where um, cryptocurrency is being traded against currency, cryptocurrencies being traded against commodities, right? And then the main purpose of forex is trading currencies against each other. So skip to the structure of the market. The structure of the market, as I said earlier, some of them are useless because with the strategy I'm using to trade right now, you wouldn't need any of them, but you have to understand them to know how the market moves. Right? So in forex or in foreign exchange trading, we have market makers or we have market movers. That's the commercial banks, the forex brokers, and then the forex exchanges. Sometimes these people can manipulate the market, sometimes they move the market, right? So I wouldn't go into details because you wouldn't need them. Then one thing I will explain, forex brokers. They are part of the structure, the forex market structures. Right? They are commission agents, meaning you sign up with them to trade the market. So they act, should I say act? They give leverage to you when you deposit your money to trade forex. They give you leverage. That leverage actually helps you maintain your position maintain your trades or help you execute trades in the market, right? So they sell or buy the forex on behalf of their customers. They are very close to the forex market. Yes, something similar to what I was saying. And one thing about brokers, when you buy, right, depending on the type of account you have with them, when you buy, they sell. When you sell, they buy. So that's how both parties make money, right? Okay. Then you have the exchanges. They are the physical markets which will be in the capital of every country. And major markets are the London, New York, Singapore. because of these people, that's why we have the time zones, the trading time zones. So we have the New York session because there's a foreign exchange in New York. We have the London session because there's a foreign exchange in London. And then Singapore. Singapore is in Asia, right? Charlie, I do geography keep. But then Singapore is in Asia. So we have the Asian session. The Asian session is in two forms. Well, I say two parts. You have the Tokyo session, and then there's another one. We most of the times don't, refer to them separately. We use the general term Asian session, Asian session. So knowing both of them is kind of a waste of time. Then you have the major currencies. So you have the Great Britain pound, the European currency, the Canadian dollar, the Swiss franc, the Japanese yen, and then New Zealand dollar, Australian dollar. These are the main, the major currencies, right? Okay. First, like the what I said previously, the types of sessions. So you have the Sydney and then Tokyo session. Yes, the Tokyo session. Tokyo is in Japan, and the Sydney is I think Singapore. Or I don't do geography anymore, so you London, New York, and then these two, Sydney and Tokyo, are regarded as one Asian session. Then you have the session overlap. These are the forex sessions, and many traders should be aware that the best time to trade is when there's an overlap of sessions. Uh, I would say this part is not true because with the time I trade, okay, it starts in the overlap. It's not true though because you can have a successful and peaceful execution outside the lab, the market session lab. But most people make profits from that lab. So that's why they will say it's the best time to trade. Now moving into the technicalities. This should be only 10 minutes. Now the technicalities. You have a pip. A pip is the display of prices with 4 decimal points. I don't trade currency pairs. So me teaching you is kind of waste of time. And then forward, as we go forward, I'll teach you how to measure the pips of what I trade, which is XAU USD, gold against the US dollar. Right. But then the general understanding about a pip is the measurement between the price movements. Right. It starts with the decimals after the point of the listing of a price of a currency pair. If I explain this to you, understand it. But if I explain what I trade, how to read the pips to you, that would be difficult. So I will hold on with the pips for now. Now, I explain currency pair is when pairs are being traded against each other. So the first pair is a quote pair, and the second pair is the base pair. So yeah, Euro USD is equal to 1.06026 and then 1.06029. So meaning when you take 1 euro and you change it into US dollar, these are the prices you should be getting, right? Now between these two prices, one of them is the buying price and one of them is the selling price. The selling price is when you have the euro and then you're going to exchange it for the dollar. And the buying price is when you have the dollar and then you're going to buy the euro. Now move to the lot size. The lot size is always a, a bit confusing, but then it's easier when you are explaining it with the currency pair that you trade. So this one, think let me try and explain a brief something about it. So uh, forget the unit thing you are talking about here. Okay, I'll hold on with the pips as well because I don't trade currency pairs and I trade gold. I will explain it when I'm explaining the pips because explaining the pips and then the lot sizes alongside the currency pair that I trade will give you much understanding. Now the spreads are basically the difference between the buying price and then the selling price. That's how the brokers make their money. Right? So after registering after registering on brokers, sometimes you note that on this broker the spreads are quite huge or quite big, but then on other brokers the spreads are lower. There are a lot of factors that causes that. One, it could be that on the broker with a lower spread, on the broker with a lower spread, it has commissions and then huge swaps attached to it, which makes it profit. Or it could be the accounts that you signed up for. And then with the ones with huge spreads, it could be that they don't have the swap and then the commissions and all that. Now let me explain swap and then commission. The swap is like an overnight fee that you pay when you hold your trades overnight. Those are the fees that you pay. And then commissions are what you pay or a certain percentage of the profits that you make, the profits or loss that you make paid to the broker. So in the case where you are paying commissions, you should note that whether you make profits or you make losses, you still pay that percentage to the broker. Okay. Now, oh, 13 minutes. Okay, let me add extra 2 minutes. Now, leverage. Leverage is what I stated earlier. I was like, brokers are what give you leverage in order to trade on the financial markets. The leverage is basically like a multiplier, right? So let's say I have $10. When you take $10 to an actual brokerage to trade, you can't enter any position. But then when you have a phone, then you sign up for a brokerage account, you can be able to trade with the $10. Why? Because after registering for an account, they give you a leverage. So leverage being the multiplier, there are a lot of leverages that you can sign up for. We have the medium risk ones, which are meant for bigger account balances. So there's 1 to 1, 1:3, 1:2, 1:10. And then you have the medium ones, 1:50, 1:100, 1:200, 1:300, 1:500. And we have the high risk leverages. That's 1:1000, 1:2000, and then 1:1 unlimited, which is given by only one broker. The 1:unlimited is given by only one broker, Xness. And here's the case: I'm not telling you to create an account with Xness, but previously or before I was doing that. I would also explain why. Yes. So with the leverage, I said you when you sign up for a brokerage account, you can be able to trade with $10 because of the leverage. Now, when you have a leverage of 1:2000, it means on the financial market, you actually multiply the $10 times 2000, which is 20,000. It means you are trading with $20,000. But when you are trading you won't see such amount on your um dashboard or in your account, because it's supposed to um it's kind of what is helping you trade on the brokerage account, but then the broker is also trading alongside you. Most people will say the broker is trading against you because when you buy, they sell, but it depends on the account you signed up for. I think I would end here, but in my next video, we will explain all the other terms and then technicalities of forex trading.